What is going on YouTube? Welcome back to another 2-Minute Tuesday. Today we are talking about the infamous credit default swaps, otherwise known as CDS. So without any further ado, let's get straight into it. Credit default swaps were created back in the day in 1994 by JP Morgan banker Blythe Masters. Credit default swaps are basically insurance against default risk. Let's say you're a bank, for example, and you've given out millions of pounds of loans to hundreds of thousands of people. Now, over a period of say 25 years, you would expect all of those borrowers to give you the money that they borrowed back plus interest, right? However, some of these people might lose their jobs, and so they might not be able to pay you back the money that they borrowed from you. And so as a result, this poses a risk to you of not getting your money back. And so in order to counteract this risk, you can buy a credit default swap, which acts as insurance against a potential default. A typical CDS has three parties that are involved. You've got the buyer of the CDS, you've got the seller of the CDS, and you've got the borrower, so the person that's taking out a mortgage, for example. Let's call the buyer party A, the seller party B, and the borrower party C. C takes out a loan from party A and they promise to pay back monthly plus interest, right? However, if A thinks that C might default later down the line because, you know, they take out a loan for 25, 30 years, so it's highly unpredictable if they will be able to pay it back. So A wants to be a bit safe, so they buy a CDS from party B. So B is the seller of the CDS, A is the buyer of the CDS. So now what they bought is insurance on party C defaulting. This isn't going to come for free. As a result, B gets a monthly payment or a premium from A for agreeing to take on any risk. So what B is doing by giving A credit default swap is that they're saying if C defaults, if C struggles to pay A any money at all, B will cover it. The bet that B is taking is that if C doesn't default, then they just got all these premium payments from A and they didn't need to cover the cost of C defaulting. So that's the bet they're taking. A is saying, okay, if C defaults, if they don't pay me my money, I'm gonna get covered by B. And it's important to note that there are many types of CDS, and what we've discussed here is the most generic and basic form of credit default swap. A few other important points to be aware of. Credit default swaps are usually customized between the parties involved. This makes them fairly opaque and hard for regulators to monitor them. A credit default swap is an easy form of money if there's no credit event. What that means is if C doesn't default, then it's easy money for B. On the flip side, if a credit event does occur, if C struggles or defaults on its payments, A doesn't need to worry because B is responsible for covering all of those costs. There are many types of credit events, some of which include bankruptcy, failure to pay, and restructuring. Once these credit events are triggered, it means the issuer, so B, will have to pay A what is due from those payments. The modeling of the CDS price is based on the probability of default as well as the recovery rate given a credit event happens. An example of the use of credit default swaps would be during the global financial crisis and the housing market crash in 2007-2008. At that time, there were $22 trillion invested in the stock market. However, there were $45 trillion invested in the credit default swap market. That just shows the summation of how big these investments were and how many people were betting on these instruments. Many investment banks were involved. The biggest casualty was Lehman Brothers. Lehman Brothers owed $600 billion in debt, $400 billion of which was in credit default swaps. Their insurance company couldn't cover that debt because it was too big, and so the Federal Reserve had to step in and bail them out. And that is this week's 2-Minute Tuesday. If you learned anything in this video, make sure you give it a thumbs up. Also, do consider subscribing to the channel if you haven't already, and leave an emoji in the comments so I know that you made it this far. Thank you once again for watching, and make sure you tune in next week to learn another financial concept, idea, or term in basic English. Thank you. Done.